All right, everybody, welcome back to the Volatility series. I'm here on the OCC, and I'm going to follow a link from here and take you into a PDF document that they've created. And I just want to use this because I gave this document to somebody before, and they kind of just went, huh, I don't get it, I don't understand. So from the previous videos, we've talked about the fact that the VIX isn't an actual thing, right? You can't buy and sell shares of VIX stock because there is no thing there, right? You can trade the options on VIX. Over the years, the formula on how that VIX is calculated has changed, and this PDF document discusses a little bit of that change. So I want to point out the OEX, that would S&P 100, that's what they used to use to calculate the VIX. And it's based on an expectation of the 30-day volatility by using at the money SPX index options, okay? That's the way it used to be. In 2003, things changed. What did they change? Well, the first thing that they changed is it's now using the SPX, so the S&P 500, not the S&P 100. Another thing that it changed is it's no longer just using at the money options, and instead it's using a lot of options. It estimates the expected volatility by averaging a weighed price of a lot of options, puts and calls over a wide range of strike prices, right? Just pause, think it through, talk it out for a moment. This was using at the money options 30 days out. This is using out of the money calls and out of the money puts all over the place. Okay. And that's how we get an average. For those of you who aren't up on your math lingo, when you want an average of something, say I have 10 people who each have a score, right? I can add up all 10 of those scores and divide it by 10, and I'd have the average. Okay, so the same thing here. The 500 SPX, they're looking at options from the puts and the calls, and they're adding it all together and giving you an average price, but it's weighed. Catch that word. It's weighed. It's not just the average, it's a weighed average. So then by doing that, they completely changed how the VIX was calculated and how solid it was and is. And that's when everything really started to grow in the VIX marketplace. Now here's something very important to understand. The VIX is a candle chart, and it's focused on the SPX. VIX options have absolutely nothing to do with the SPX. I know. It's a little weird. Just kind of stick with me here. If you look at the VIX on a chart, the candles here are a representation of the SPX implied volatility, right? We talked about that in previous videos. So that's what we're looking at here. This is just like, it's just like looking at the implied volatility indicator on the SPX. That's what these candles are. But when you get into the trade side and you're looking at these options have nothing to do with these candles at all. At the money and options have nothing to do with where the price of the VIX is. The options in the VIX go to the VIX futures. Okay, so we're going to unlink that so it stays there, and we're going to change this to VIX futures. So this is the VIX volatility futures. Okay, those options in the VIX go to this product, and I don't know what's wrong with Thinkorswim here. is not working very well, huh? But that's what it is. Okay, so it's real important to understand this. I mean, I can't stress it enough. If you want to trade options in the VIX, you damn sure need to know where at the money is, right? So, you know, at the money, if you're very, very close to expiration, it's going to be very, very similar to the VIX candles, okay? But if you go out in time, even 16 days, you're going to really want to look at the VIX futures because that's going to be a better representation of what those options are doing. So I hope I haven't lost you here so far, okay? We got to get back to this. You got to be able to understand a tradable asset, right? That's critical to understand a tradable asset. If you're going to trade in the VIX, if you even go to the VIX and you're trying to gauge what's going on in the market, you're not going to want to go to the VIX to get an understanding of what's going on in the market. You're going to want to go to the VIX futures. If you're looking for a confirmation of fear, if you're looking for an increased order activity, maybe you think people are trying to hedge in against the election or some volatility in the future, it's not the VIX that you want to look at. It's the VIX futures that you want to look at. All right. Another thing that is important to understand is there are a lot, and I mean a lot, of VIX products out there. Okay. There's the VIX, yes. But look at what we also have. The NASDAQ 100 Volatility Index, the Dow Jones Volatility Index, the Russell 2000 Index, and then the CBOE 500, which is, remember, that's this up here, the S&P 500 3-month index, the VXV. Okay, so it can be a lot. You can get lost in all the different things out there. There's crude oil volatility indexes, gold indexes, the euro. There's so many different volatility tools out there because once they came out with that new formula back in 2003, they revolutionized the formula. That like this changed everything. And then they started to realize, hey, this thing is so solid. This formula is so amazing. We can use this on all kinds of stuff. And that's what they started to do. Now, you wouldn't want to go and look at the Russell 2000 Volatility Index to try to get a gauge or an understanding of what's going on across the marketplace. But you could perhaps look at this if you're thinking of building a position in the Russell for a long-term swing trade. What is the expectation of forward movement in the Russell? Is that thing still going to be a dog and continue to drag its feet? Or is it looking like it could potentially make some good moves this year? How far could we expect it to move? All right. So when we start getting into this kind of volatility, not the implied volatility off of the charts, right? Not from that kind of volatility. But when we start getting into the options implied volatility, we want to understand what that formula is doing, what it's trying to tell us. So when we go in here and we look at it, said that it's using an average, a weighed average. Now, at some point in this document, it's going to get us to the formula. Okay, there's the formula. You don't need to do this formula. Okay, you don't need to. You can go your whole life without ever having to learn how to do this formula. You just need to understand that the VIX is only a formula. That's it. It's a volatility index comprised of options rather than stocks. Okay? That's all. And you need to be able to do this formula only if you want to be a geek and find a proprietary edge somewhere. I promise you don't need it. Now, the VXO is what they used to use for the settlement value. VRO is what I have learned to use as a newer product. Okay, so here's the VRO. It's the settlement index. And if you're sitting there wondering, what the heck is that? Okay, so remember that if implied volatility, the VIX, if that's calculated based on an average of options, then when these options, when VIX actually does expire, what's the real price, right? Options prices change so quickly, and they go back and forth, and they're up and they're down, and they're all over the place. How can everybody agree on what the expiration value is for VIX options at expiration? And where can we find that? You can find it here. Now, it's hard to see this, so I'm going to change the style of the chart and turn it into an area. But it's important to understand what we were looking at. These are just one dash. At the open on Wednesday morning, they recorded the value of the SPX options. They drew a line in the sand and said, that's it. That was the value. That's where we were. That's the settlement price of those options. And they only do it on Wednesday morning. So every Wednesday at the open, they look at the SPX, they mark the value of the options, and they say that's the settlement for the VIX. And then a week goes by, and they do it again, and they do it again. And so when I turn this into an area chart, we can see a curve. We can see the trend. Is the trend going down? Is the trend going up? And that is the value of looking at the VRO. It's understanding what the price of the VIX was when those options expired. When we go into the VIX, let's change this. These options are European style options. They cannot be traded after Tuesday evening, and they expire Wednesday morning. At expiration, we need to know what the price of the VIX is, and it needs to be locked in place, agreed upon by everybody, so that there's no haggling or disagreement. The VRO gives that to everybody. Okay, and then from this, we can look at the historical trend and say what's happening with the VIX options. Are they getting more expensive? Are they getting less expensive? Remember that the VIX is a mean reverting product. It will always go back to the mean, to the average. So when it gets extreme, contrarian trade strategies might be something that you want to think about, because it will eventually work its way back down to the average. Now it's going to have an elevated average for quite a while. You can see all the way back to 2015. We are in an extreme right now that we haven't seen in a long time. There's a 20-year average. We can go all the way back to 2008, to the housing crisis. And remember that if we was to put this chart to show all max available, we can only go back so far with the VRO because it changed. It was the VXO. Okay, the VXO is when they were still using the S&P 100. And I believe there still is a VXO. It's just from the OEX options instead of the more current system. And it talks right here. You can compare the new VIX with the old VXO. And you can click on that, and then you can look at other volatility indexes. So here's that formula. We don't need the formula, right? You just need to understand that the VIX comes from a formula, that it's not a real thing. I don't want to go too long in this video. It's been something that I'm really focusing on, keeping these less than 20 minutes. I think we've gone far enough. I appreciate your time, guys, and I look forward to seeing you at the next video.